volume doesn't confirm trends. It confirms manipulation. And if that statement already feels uncomfortable, good. That means your mind is still awake, not hypnotized by the same recycled trading lessons they've been feeding retail traders for decades. You've probably heard the line 1,000 times, always trade with volume confirmation. They tell you, when the price breaks a level with high volume, that's a real move. But if that were true, how come most of those confirmed breakouts end up reversing, trapping the very traders who waited for that so-called confirmation? See, the problem isn't with volume itself, it's with how you've been taught to read it. You're looking at the symptom, not the intention behind it, because every spike, every bar, every sudden surge in volume is just a reflection of one thing, someone's agenda being executed in real time. And in this market, it's not the crowd's agenda that moves price. It's the ones creating the illusion of movement that control everything. Think about this. You're sitting at your screen. Price breaks resistance. Volume explodes. You think, finally, institutions are stepping in. But pause for a second. If real institutions are entering, why would the volume explode? Big players don't need to announce their entries. They accumulate quietly over time across multiple zones without leaving a footprint. The only time they need volume is when they're exiting, when they want liquidity, when they need someone, you, to take the other side of their trade. That's the first layer of the trap. They build the move silently and they exit loudly. The volume spike isn't confirmation of strength, it's confirmation of distribution. They've created excitement, they've built the story, they've attracted eyeballs. And when you and a million other traders hit buy, thinking you're joining the big money, you're actually providing the exit liquidity for it. That's why every strong breakout with big volume feels convincing but ends in pain. Because the move wasn't built for you, it was built around you. Let me tell you how this game really works. Let's say a fund wants to unload a massive position. They can't just hit sell, it would crash the market instantly. So they need to create buyers. How do they do that? They engineer momentum. They push the price into a breakout zone, maybe release some bullish news, maybe a few influencers suddenly start talking about it. Retail traders swarm in. Boom, volume spikes. That's their moment. They dump their position right into that wave of demand. Volume confirms the illusion. Everyone celebrates the confirmation. But by the time you see it, the move is already over. You've seen this in crypto, right? Bitcoin runs from 30K to 60K. Volume explodes. CNBC calls it institutional adoption. And within weeks, the price collapses 50%. The same pattern repeats in stocks, forex, even commodities. The volume never confirms the beginning of truth. It confirms the end of deception. It's the final act of a performance carefully staged by the ones who profit from your belief in it. Now let's go even deeper, because the deception isn't just on the chart. It's psychological. You've been conditioned to believe that more means stronger. More volume, more confirmation, more confidence. But in trading, that's reversed. Real strength hides in silence. Real accumulation happens in low volume zones where no one's watching. It's the quiet, boring, sideways markets, the ones you skip because nothing's happening, that are the foundation of every major move. You've probably noticed it too. When price breaks out of a long consolidation with low volume, it often continues. Why? Because it was built on quiet, careful accumulation. The smart money already did their work before the public arrived. By the time you see the high volume, it's no longer accumulation, it's distribution. The show's over, and you're buying their exit. But here's what they don't want you to know. Volume doesn't move price, orders do. Volume is just the footprint left behind after the move is already in progress. And most of that volume? It's not real participation. It's algorithms pinging each other, fake liquidity injections, dark pool orders hidden from public view. The number you see is just a distorted reflection of activity, not intention. In fact, one of the biggest misconceptions retail traders have is believing that volume is equal to buying pressure. It's not. Every buy has a sell. What matters is who is on each side. A candle closing bullish on high volume could mean big players are unloading into retail demand. A bearish candle on low volume might actually mean there's no more supply, a setup for a reversal. But because you were taught to read volume in a linear cause and effect way, you miss the context completely. Let me give you a real example from the stock market. Remember GameStop in 2021? Retail traders saw volume through the roof, millions of shares being traded. Everyone shouted, "Volume confirms strength. Institutions can't stop this." But in reality, that volume was the exit door. The crowd was entering, the funds were exiting, and within weeks the price collapsed. Volume didn't confirm the trend, it confirmed the transfer from smart money to dumb money. And the same story repeats every single day in different forms. The Forex market, where fake liquidity zones get printed before news events. Massive volume spikes right before reversals. The options market, where huge open interest appears in one direction, retail piles in, and the next day volatility crushes them. Everywhere you look, volume is used not as a tool of truth, but as a weapon of deception. But there's a way to read it differently. You need to train your eye to see what's missing, not what's visible. When price hits a key level and volume disappears, that's not weakness, that's absorption. It means the big money is taking the opposite side quietly, soaking up retail orders without revealing themselves. When volume dries up completely before a breakout, that's the calm before the storm. That's when the professionals have finished their positioning, and all they need is one small push to trigger the herd. Let's take a practical case. Imagine a stock forming a tight range for 10 days. Volume starts decreasing each day. The public loses interest. Then suddenly, one small green candle breaks the range on slightly higher volume. Not a spike, just a bump. That's not retail chasing. That's institutional ignition. The smart entry is there, not when volume explodes. But what does retail do? They ignore that. They wait for the confirmation, and when volume finally spikes 3 days later, they buy, right when the institutions are taking profit. This pattern never fails because it's built on human psychology. We crave certainty, and volume looks like certainty. It feels measurable. But the market feeds on your need for confirmation. It sells you the illusion of confidence so it can harvest your liquidity. That's why every indicator, every volume-based strategy is designed to make you react, not observe. And this is where you have to flip your mindset. Stop asking, is this volume confirming the move? Start asking, who benefits from this volume appearing right now? Because when you see that giant green candle with record-breaking volume, the question isn't, should I enter? The question is, who's exiting? The truth is, volume is the loudest lie on the chart because it tells you everything and nothing at the same time. It's data without direction, numbers without narrative. You give it meaning. And if that meaning is based on the textbook version, you're trading the same playbook the market uses against you. Let's break it down even more practically. Next time you look at volume, ignore the spikes. Zoom out. Look at the quiet periods. Ask yourself, where did the market start building energy? Where did the volume not react to price movement? That's where manipulation starts. That's where they hide their real intent. Volume should be used as a timing filter, not a trigger. When you see divergence, rising volume with flat price, or rising price with falling volume, that's where you dig deeper. Those are the footprints of power-shifting hands. And once you start seeing it, you can't unsee it. You'll notice how every news-driven rally is preloaded with quiet volume absorption days earlier. How every crash begins with a sudden, unnatural burst of volume designed to trigger emotion. You'll see how your broker, your favorite analyst, even the media use volume analysis to justify moves after they've already happened. Never before. Because the illusion must stay alive. The story must sound logical. And volume is the perfect narrative tool. So if you're serious about evolving as a trader, stop worshiping volume spikes like divine confirmation. Start studying what happens before them. Watch how volume behaves at extremes, when price is at its highest optimism or lowest despair. You'll start to notice a pattern. The market whispers before it screams. And maybe, just maybe, you'll start realizing that the very indicator you thought was confirming the truth was confirming the lie. So next time, when you see that beautiful breakout, the perfect setup, the giant green candle backed by massive volume, take a breath. Don't react. Don't chase. Ask yourself one simple question. Who needs me to believe this is real? Because once you understand that, you'll stop being part of the crowd and start trading like the ones who control it. And if this opened your eyes even a little, don't forget to stay with me. because in the next session, we'll go step by step through live charts and decode real volume traps in action, so you can see, with your own eyes, how manipulation hides in plain sight. Stay tuned. The truth's just getting started.